What happens to your money if war breaks out in the Middle East? Not a hypothetical, not a history lesson. A real question that millions of Americans are asking right now, and most of them have no idea how to answer it. Will the stock market crash? Will oil hit $150 a barrel? Should you sell everything and hide in cash? Or is this actually one of the biggest buying opportunities of the decade? Here's the truth. Most financial media will scare you into paralysis. That's not what we're doing today. In this video, I'm going to walk you through exactly how a Middle East conflict ripples through the global economy, what it does to the US stock market, which sectors win big and which ones get destroyed, and most importantly, the specific investment strategy you should be executing right now. This is strategy, not fear. Let's get into it. Before we talk about your portfolio, you need to understand why the Middle East has this much power over the global economy, because once you understand the mechanism, everything else makes sense. It comes down to one word: oil. The Middle East sits on top of the largest concentration of proven oil reserves on the planet. Countries like Saudi Arabia, Iraq, Iran, Kuwait, and the UAE collectively produce a massive share of the world's crude oil supply. And not just production, the region controls critical shipping lanes, including the Strait of Hormuz. Roughly 20% of the world's oil passes through that single choke point every single day. So when conflict breaks out, when supply gets disrupted, when shipping routes become dangerous, when producers pull back, the global oil supply tightens almost immediately. And here's the chain reaction that follows. Oil prices spike. When oil gets expensive, everything that depends on oil gets expensive. Trucking costs more, manufacturing costs more, shipping costs more, and eventually, that cost gets passed directly to consumers, at the grocery store, at the gas pump, everywhere. That's inflation, and inflation is the enemy of financial markets. Here's why. When inflation rises, the Federal Reserve is forced to respond. They either keep interest rates high or they delay the rate cuts that markets have been desperately waiting for. Either way, it puts pressure on stocks. Earnings get squeezed, borrowing becomes expensive, consumer spending slows, and the stock market, which is essentially a forward-looking pricing machine, starts discounting all of that future pain right now. So even if you've never set foot in the Middle East, even if the war is happening 7,000 miles away, you feel it through your gas bill, through your grocery receipts, through your 401k. That's why this matters. Now let's talk about what actually happens to the stock market when a Middle East conflict escalates. History gives us a clear playbook, and it happens in 3 phases. Phase 1 is shock and fear. The moment conflict becomes real, when headlines are screaming, when images are everywhere, the market's initial reaction is almost always negative. Investors hate uncertainty more than they hate bad news. Uncertainty is unquantifiable, and markets don't like what they can't price. You'll see the S&P 500 drop. The Nasdaq usually gets hit harder because tech stocks are risk-sensitive. They're priced on future growth, and future growth feels less certain in a crisis. The VIX, the volatility index, often called the fear gauge, spikes, and money floods into safe haven assets, gold, US treasuries, the dollar. And here's something important to understand. Modern markets move fast, incredibly fast. Algorithmic trading systems react to headlines in milliseconds, so that initial drop can feel violent and sudden. It's designed to feel that way. But here's what most retail investors miss. Phase 2 is sector rotation. After the initial panic, smart money doesn't leave the market. It rotates. It moves out of sectors that are vulnerable and into sectors that benefit from exactly this kind of environment. We'll cover exactly which ones in a moment. And then phase 3 is stabilization. If the conflict stays contained, if it doesn't escalate into a regional or global war, markets historically recover. Sometimes within weeks, sometimes within a few months, but they recover. The single most important lesson from market history: markets price in fear quickly, and they almost always overreact on the downside. That overreaction, that's where opportunity lives. Now let's talk about oil in more detail, because oil is the heartbeat of this entire situation. If a Middle East conflict disrupts supply through damaged infrastructure, blocked shipping lanes, or sanctions, crude oil prices can spike dramatically and quickly. We've seen it happen before. During the Gulf War in 1990, oil prices doubled in a matter of months. After the Arab oil embargo in 1973, prices quadrupled. Now, what does that actually mean for everyday Americans? Gas prices rise fast. If you're commuting, that hits your wallet immediately. Airlines see their single largest operating expense, jet fuel, skyrocket overnight. Shipping companies raise rates. Manufacturers pay more to move raw materials. Food prices increase because food production and distribution runs on fuel. And when consumers are spending hundreds more per month on energy, they spend less everywhere else. Restaurants, retail, entertainment, it all slows down. That slowdown filters into corporate earnings, and earnings drive stock prices. But here's the part most people overlook, and it's critical. Higher oil prices aren't bad for everyone. They are extraordinarily good for domestic energy companies. America is now one of the world's largest oil producers. Companies like ExxonMobil, Chevron, ConocoPhillips, when oil goes to $100, $110, $120 a barrel, their profit margins explode, their stock prices surge, their dividends grow. So while the broad market may pull back, the energy sector can rally hard, and investors who are positioned in energy before the conflict escalates can profit significantly. The lesson: oil is a two-sided trade. It punishes consumers and growth companies, and it rewards energy producers. Your job is to be on the right side of that trade. Now let's get specific, because not all sectors are equal in a geopolitical crisis, starting with the winners. First, energy stocks. This is the most direct play. When oil rises, energy company revenues rise proportionally. Integrated majors, independent oil producers, pipeline operators, refining companies, they all benefit. If you want one sector to be overweight during Middle East tension, it's energy. Second, defense contractors. When war becomes real, governments spend money. Military budgets expand. Defense contracts get fast-tracked. Companies that build fighter jets, missile systems, drones, surveillance technology, they see their order books fill up almost immediately. Names in the defense space have historically outperformed during every major geopolitical escalation. Third, oil field services and infrastructure. These are the companies that help energy producers drill more, produce more, and transport more oil. When oil prices are high, energy companies reinvest heavily in production, and these companies capture that spending. And fourth, gold and precious metals. Gold is the ultimate safe haven asset. When fear spikes, when inflation rises, when currencies feel unstable, gold rises. It's been that way for centuries. A position in gold or gold miners acts as a portfolio insurance in exactly this kind of environment. Now let's talk about the losers. Airlines are hit first and hit hardest. Fuel is their biggest single cost. When jet fuel doubles, their profit margins evaporate, and fear of travel compounds the problem. Travel and hospitality broadly suffers. Hotels, cruise lines, international tourism, all of it contracts when global uncertainty rises. People cancel trips, bookings fall. Consumer discretionary stocks, think retail, restaurants, luxury brands get squeezed as inflation eats into household budgets. When people are paying more for essentials, they cut back on everything else. And high-growth technology stocks, the ones trading at high price-to-earnings multiples, suffer in a high-interest rate environment. If the Fed keeps rates high because of oil-driven inflation, the math on future earnings gets worse, and these stocks reprice lower. Now, and this is important, none of this means these sectors are done. It means they face short-term headwinds, temporary pressure. The companies themselves don't disappear. Airlines will fly again. Tech will innovate again. The question is your time horizon and your positioning. Here's some context that should give you confidence. The U.S. economy is significantly more insulated from a Middle East conflict today than it was 20 or 30 years ago, and there are 3 big reasons why. Number 1, America is an energy powerhouse. Thanks to the shale revolution, the U.S. now produces more oil and natural gas than almost any nation on Earth. We are far less dependent on Middle Eastern oil imports than we were during previous crises. That is a genuine structural advantage. Number 2, the U.S. dollar remains the world's reserve currency. When global crisis hits, money doesn't run away from America, it runs to America. Foreign investors buy U.S. treasuries. They buy dollar-denominated assets. That flight to safety actually strengthens the dollar in a crisis, which gives the U.S. economy a real cushion. In number 3, U.S. treasuries are the world's safest asset. In a global panic, there is no more trusted investment on Earth. That demand keeps U.S. borrowing costs manageable. But, and this is a real but, the inflation risk is still significant. If oil spikes to extreme levels, the consumer price index rises. The Federal Reserve, which has been trying to normalize interest rates, finds itself stuck. Rate cuts get pushed back. Mortgage rates stay high. Business borrowing becomes expensive. Consumer confidence drops. The biggest risk to the U.S. economy from a Middle East war isn't direct destruction. It's the indirect inflation tax that gets applied to every American household. That's the threat, and it's real. Alright, let's get to the part that actually matters. What you should be doing with your money. 5 principles. Write these down. Number 1, do not panic sell. I cannot say this strongly enough. Panic selling is the single most wealth-destructive behavior an investor can engage in. Every time markets have sold off on geopolitical fear, every single time, the investors who sold at the bottom regretted it within 12 months. You don't crystallize a loss until you sell. Stay disciplined.
Number 2, diversify with intention. If your portfolio is 100% concentrated in growth tech stocks right now, you are exposed. You need broad market index exposure as your geopolitical hedge, utilities, healthcare. You need defensive sectors because these businesses keep paying regardless of what's happening in the world, and you need some cash. Number 3, add defensive exposure, energy stocks, defense contractors, dividend-paying shock absorbers, utilities. These companies, they don't make go up 200%, go bull run, but they hold value in yield income when everything else is volatile. Number 4, keep cash on the sideline. Volatility is not just risk, it's opportunity waiting to be priced. If market drops 10%, even 20% on 15% geopolitical fear, and you have cash, you can buy world-class companies at a discount. The best investors in better information. They had cash when others didn't. Number 5, long-term investors, hold your course. If you are investing for retirement that is 10, 20, 30 years away, geopolitical noise is uncomfortable, headline-grabbing noise, but it is noise. The U.S. stock market has survived 2 world wars, the Cold War, Vietnam, 9/11, the 2008 financial crisis, and a global pandemic. It has trended upwards. Don't let a 3-month crisis destroy a 30-year compounding strategy. Section 7, worst case versus most likely scenario. Let's be real about the range of outcomes. In the worst case, a full regional war that draws in multiple nations, severely disrupts oil supply and triggers a global economic downturn. Markets could temporarily drop 15 to 25%. Oil prices could spike meaningfully. Inflation could spike meaningfully. Recession would be a real possibility. This is possible. It is not inevitable. In the most likely scenario, a contained conflict that causes an oil price spike but stabilizes within weeks, even if VDU and VDS can't be separated. Volatility is elevated for a quarter or 2. The energy sector outperforms, and the broad market is higher. Most likely path supported by historical data. History overwhelmingly supports the second scenario, not because war isn't serious, but because markets are forward-looking, adaptive, and relentless. They price in the fear, then they move on. The Middle East is a pivotal hub for global energy. Through collaboration and strategic foresight, we can navigate the complexities of this region to ensure the stable and sustainable future for all. Let's work together. Bottom line, war creates uncertainty. Uncertainty creates volatility, and volatility for the prepared investor creates opportunity. You cannot control what happens in the Middle East, but you absolutely 100% control how you allocate your capital. The investors who win through geopolitical crises are not the ones with the best predictions. They're the ones who don't panic, the ones who have a plan, the ones who position strategically when others are reacting emotionally. Be that investor. If this breakdown gave you real clarity, subscribe, because this channel is built for people who want serious market strategy, not hype, not fear, not noise, just disciplined, intelligent investing. I'll see you in the next one.